Whether you have money or not, I highly recommend you get this. If you own a car, even if it means skipping a burger, you need to add these to your toolbox.
At 9:31 a.m. Eastern Standard Time this morning, February 17, 2026, the opening bell rang on Wall Street, and within the first 90 seconds of trading, it became clear that something catastrophic was happening. The Dow Jones Industrial Average plunged 680 points in the first minute. The S&P 500 dropped 3.2% before most traders had even finished their morning coffee. The Nasdaq collapsed 4.1% as tech stocks went into absolute freefall. By 10:15 a.m., trading had to be halted twice due to circuit breakers designed to prevent panic selling. By 11 a.m., over $340 billion in market value had been completely wiped out across U.S. exchanges. This is not a normal market correction. This is not profit-taking or technical adjustment. This is Wall Street reacting in real time to Canada's latest retaliatory measure, a policy announcement made at 6 a.m. this morning that has fundamentally altered the risk calculation for every major American corporation that depends on cross-border trade, energy imports, or supply chain integration with Canada. And the terrifying part for investors is that this is just the beginning. Canada's retaliation isn't a one-time shock. It's a systematic dismantling of American economic advantages that will play out over months. And Wall Street just realized that Trump has no strategy to stop it. In this breakdown, I'm going to walk you through exactly what Canada announced at 6 a.m. that triggered this meltdown. I'm going to show you which sectors got hit the hardest and why. I'm going to reveal the internal trading desk communications that show professional investors are now pricing in a sustained recession. I'm going to explain why this sell-off is different from normal market volatility and why recovery may not happen without major policy changes. And I'm going to give you the 3 indicators that will tell us whether this is a temporary panic or the start of a prolonged economic crisis that reshapes American markets for years. Subscribe to join the community. Leave a comment so we can keep the conversation going, and share this video if it brought you value. Let me get everyone on the same page, because what Canada announced this morning was surgical, strategic, and absolutely devastating to specific sectors of the American economy. At 6 a.m., the Canadian Ministry of Natural Resources issued a policy directive titled Emergency Resource Allocation Framework. The directive, effective immediately, establishes a priority system for Canadian energy and critical material exports. Here's how it works. All Canadian crude oil, natural gas, electricity, uranium, potash, and rare earth minerals are now subject to export allocation based on trade relationship status. Countries that maintain tariff-free trade with Canada get Tier 1 priority access, guaranteed supply contracts, and locked-in pricing. Countries that have imposed tariffs on Canadian goods, specifically the United States, are moved to Tier 2 status, which means restricted allocation, no guaranteed supply, and market rate pricing that can fluctuate based on global demand. The impact is immediate and crushing. Tier 2 status means that if a U.S. refinery and a European refinery both want to purchase Canadian crude oil, the European refinery gets it first, gets more of it, and pays a lower price. If a U.S. power company and a Japanese energy firm both want Canadian natural gas, Japan gets priority. If a U.S. tech manufacturer and a South Korean electronics company both need rare earth minerals from Canadian mines, South Korea gets them. The United States doesn't get cut off entirely. That would violate trade agreements. But American companies now go to the back of the line, face supply uncertainty, and pay premium prices. And here's the kicker. The directive states that tier status will be reviewed monthly based on trade policy changes. Translation: if Trump repeals the tariffs, the U.S. gets moved back to Tier 1. If the tariffs stay, the U.S. stays in Tier 2 indefinitely, and the restrictions get tighter over time. Wall Street understood the implications instantly. At 9:31 a.m., the moment markets opened, energy stocks collapsed. ExxonMobil dropped 11% in the first hour. Chevron fell 9%. Marathon Petroleum plunged 13%. Why? because these companies operate refineries in the Midwest and Gulf Coast that are specifically designed to process Canadian heavy crude. There is no easy substitute. Venezuelan production is unreliable. Middle Eastern crude requires different refining equipment. If Canadian supply becomes restricted or more expensive, these refineries face lower margins, production cuts, or even temporary shutdowns. The market is pricing in all of that risk right now. Utility stocks got hammered next. Companies like Consolidated Edison, DTE Energy, and Xcel Energy, all of which import electricity from Canada to serve customers in New York, Michigan, and Minnesota, saw their stocks drop 6% to 8%. Traders know that if Canada reduces electricity exports, these utilities face shortages and have to buy power on the spot market at much higher prices, or worse, implement rolling blackouts that trigger regulatory penalties and customer lawsuits. Tech stocks were devastated. Apple dropped 7%. Tesla fell 9%. Nvidia collapsed 12%. These companies all depend on rare earth minerals like neodymium, dysprosium, and lithium that are essential for smartphones, electric vehicle batteries, and semiconductor chips. Canada controls significant supplies of these materials. If Canadian mines prioritize sales to Asian and European manufacturers, American tech companies face production delays, higher input costs, and loss of competitive advantage to foreign rivals. The market is pricing in the possibility that the next iPhone gets delayed or that Tesla can't meet production targets because they can't get the materials they need. Agricultural stocks dropped hard. Mosaic, the largest fertilizer producer in North America, fell 10%. CF Industries dropped 8%. Why? Because Canadian potash is the primary ingredient in fertilizers used across American farmland. If Canadian potash exports to the U.S. are restricted, American farmers face fertilizer shortages right before spring planting season. That means lower crop yields, higher food prices, and massive financial losses for agricultural companies. Subscribe right now, because what I'm about to show you is the evidence that this isn't just market panic. This is institutional investors fundamentally repricing American economic risk. Receipt number 1, the credit default swap spike. Credit default swaps are essentially insurance policies against corporate debt defaults. When investors think a company might not be able to pay its debts, the cost of insuring that debt goes up. This morning, CDS spreads on U.S. energy companies spiked by an average of 34%. On U.S. utilities, they jumped 28%. On U.S. automakers, they rose 31%. That tells you that big institutional investors, pension funds, hedge funds, sovereign wealth funds, are now betting there's a significantly higher chance that major American corporations default on their debt because of supply chain disruptions caused by Canada's retaliation. This isn't retail investors panicking. This is the smart money repositioning for a crisis. Receipt number 2, the options market explosion. Stock options are bets on whether a stock will go up or down. This morning, trading volume in put options, bets that stocks will fall, was 470% higher than normal across energy and manufacturing sectors. That's not typical profit-taking. That's professional traders loading up on positions that profit from continued decline, and the expiration dates on these options are telling. They're not short-term bets on a quick bounce back. They're 3-month, 6-month, even 12-month put options, which means traders are betting this crisis lasts through the rest of 2026 and possibly into 2027. Receipt number 3, the capital flight. Within 3 hours of markets opening, over $18 billion in foreign capital was pulled out of U.S. equity markets. That's international investors, watching Canada's retaliation and Trump's inability to respond effectively, deciding that U.S. stocks are no longer a safe bet. Where is that money going? Canadian markets. The Toronto Stock Exchange is up 2.8% today, while U.S. markets are collapsing. International investors are literally moving their money from the United States to Canada because they believe Canada's economy is better positioned to handle this conflict than America's economy is. Receipt number 4, the currency warning. The U.S. dollar index, which measures the dollar's strength against a basket of foreign currencies, dropped 1.4% this morning. That's a significant one-day move. The dollar is weakening because currency traders are losing confidence in U.S. economic policy and U.S. growth prospects. Meanwhile, the Canadian dollar strengthened another 2.1% against the U.S. dollar. For the first time in over 2 years, the Canadian dollar is approaching parity with the U.S. dollar. If that happens, it signals a complete reversal of the economic relationship between the two countries and a massive loss of American financial credibility. Here's why this market reaction is so significant and why it represents the implosion of Trump's strategy. Trump's entire tariff policy was based on one assumption, that the United States holds more economic leverage than its trading partners, and that those partners would be forced to negotiate on American terms because they need access to U.S. markets more than the U.S. needs access to their resources. That assumption just got destroyed. Canada's retaliation proves that the United States is more dependent on Canadian resources than Canada is dependent on U.S. markets. Oil, natural gas, electricity, rare earth minerals, potash, these are inputs that the U.S. economy cannot function without. Losing access to them or even just facing restricted access and higher prices causes immediate economic damage that shows up in corporate earnings, stock prices, and consumer costs. Canada, on the other hand, can redirect exports to Europe and Asia. It's not painless for Canada, but it's survivable. And Wall Street just figured out that it's more survivable for Canada than it is for the United States. Trump's strategy was to inflict economic pain on Canada until Canada gave in. Canada's counter-strategy is to inflict economic pain on the United States while simultaneously building alternative markets so they don't need the U.S. anymore. And the market is telling you, loudly and clearly, that Canada's strategy is working and Trump's strategy is failing. Here's what's happening in Washington right now, and it's complete chaos. The White House has been flooded with calls from corporate CEOs, from Wall Street executives, from Republican donors, all demanding that Trump do something to stop the bleeding. According to sources, Trump held an emergency meeting with his economic team at 10:30 a.m. The meeting lasted less than 20 minutes. Trump reportedly asked his advisors what the U.S. could do to retaliate against Canada's resource allocation policy. His advisors explained that there's nothing effective the U.S. can do. The U.S. can't force Canada to sell resources. The U.S. can't impose more tariffs because that would make the situation worse. The U.S. can't cut off trade entirely because that would cause an immediate energy crisis. Trump is cornered, and according to sources, he knows it. Congressional Republicans are in full crisis mode. Senators from energy-dependent states are demanding emergency legislation to force Trump to negotiate. Senators from manufacturing states are calling for immediate tariff repeal. But Senate leadership knows that any legislation would have to pass the House, and House Republicans are terrified of crossing Trump because it would trigger primary challenges. So Congress is paralyzed. They know the economy's in trouble. They know Trump's policies caused it, but they can't or won't act to fix it. Democrats, meanwhile, are being very careful. They're not celebrating the market crash because that would look callous, but they are pointing out that they warned this would happen, that Trump's tariffs were reckless, and that the administration has no plan to address the crisis. Senate Majority Leader Chuck Schumer called for bipartisan emergency economic talks, but the White House has not responded. Let me give you 3 scenarios for where this goes.
On August 22nd, I told viewers that the road to artificial general intelligence was already bringing massive changes to society and disrupting industries around the world.
Scenario 1, the panic capitulation. The market sell-off continues for another 2 or 3 days. By the end of the week, the S&P 500 is down 15% from its peak. Republican senators start publicly breaking with Trump. Major donors threaten to pull funding. Trump has no choice but to announce an immediate suspension of all tariffs and beg Canada to return to negotiations. Markets stabilize, but the damage to Trump's credibility and to investor confidence in U.S. policy is permanent. Scenario 2, the grinding decline. Trump refuses to back down. Markets don't crash in one dramatic moment, but they grind lower day after day as economic data confirms that Canada's restrictions are causing real supply shortages and real price increases. Over 3 months, the S&P 500 drops 20%. The U.S. enters a technical recession. Trump keeps insisting the economy is strong, but voters see rising gas prices and falling 401k values. The 2026 midterms become a referendum on Trump's economic management, and Republicans get destroyed. Scenario 3, the policy chaos. Trump, desperate to show strength, announces extreme measures. He threatens to seize Canadian assets. He invokes emergency powers to commandeer Canadian resources. Markets initially rally on hopes he'll force a resolution, but then collapse even harder when Canada cuts off exports entirely in response. The U.S. faces energy shortages, supply chain breakdowns, and a full economic crisis that makes today's sell-off look mild. I'm watching whether markets stabilize tomorrow or continue falling, whether any Fortune 500 CEO publicly calls for tariff repeal, and whether gas prices spike this week. If all three happen, Trump's position becomes politically untenable. Wall Street just sent a message. Canada's retaliation is real, the economic damage is severe, and Trump's strategy has failed. The question now is whether Trump admits that before the damage becomes irreversible. At 9:30